Welcome to Trends with Benefits, an award-winning podcast by VanEck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Hi, Ima. How are you?
Hi, Ed. Happy to be here.
Yeah, thanks for coming on the show. Finally was able to get you on the show, and we can talk about gold. Congratulations, recently appointed portfolio manager for the VanEck Gold and Precious Metal strategy. It's an active strategy. That was as of May, is that right?
May 1st. Yes. Thank you. Very excited.
That's awesome. But you've been on the team and at VanEck for quite a while now.
Yeah, I've been at VanEck since 2011. So this is my 12th year. Officially assigned deputy portfolio manager at 2014. Fast forward 2023. Lead portfolio manager. So yeah, it's been great.
That's great. And I think it's almost always interesting times for the gold market, isn't it? But is it more so now? It seems like there's a confluence of events and things going on that perhaps really kind of sets the stage for gold.
Yeah, actually, I've been having a lot of meetings and presentations and webinars recently, and you put it well. And it's actually how I've started a lot of my conversations is, listen, this is a pretty unique moment in that it is enough that, that I get to talk about gold and the benefits of owning gold right after, a pretty significant banking crisis. Yes, it was short-lived. It was contained, at least as we see it now. But it was unexpected. It did also highlight how gold behaves in those moments of crisis. So you're right in that I think it is very relevant today to talk about gold.
Awesome. So we are speaking with Ima Casanova. Again, mentioned that she is a portfolio manager for VanEck's active gold and precious metal strategy. And exactly this is what I wanted to bring her on for, to talk about gold markets, gold miners, what she's seeing today. There's a lot going on in markets in general, and this is a topic that's of course close to the heart of VanEck and many investors. So I'm really thrilled to have her on the podcast. One of the things that we've been talking about internally, and I thought it was a really interesting data point. Maybe we could start here. You mentioned the banking crisis, and I know there's other factors going on in the market. But what I thought was interesting, there was a data image that our teams were going back and forth on, and I thought it was really interesting. It was the correlation, if you will, or the divergence of gold price and gold holdings by ETFs. And for a long time, I think for at least several years, that correlation has been very tight. Gold price moved along with gold holdings. But I think as of November of last year, 22, that diverged, where gold holdings went down and kind of stayed flat, but gold price continued to go up. And so the question to kind of start out the show is, who's buying?
Yeah, in fact, it is something we've been highlighting since late 2022 last year, where we saw precisely what you're saying, really since the existence of the gold bullion ETFs, the correlation between the gold price and the holdings in the gold bullion ETF has been very, very strong. And we use gold bullion ETF holdings as a proxy for investment demand. So when we want to assess the sentiment and how investment demand is shaping up, we look at what's happening, inflows, outflows out of the gold bullion ETF. And like you point out, as we know, since the lows of, say, October, November of 2022, gold had a really strong rally, up over 20% since. And when you look at the gold bullion ETFs, is that there's been no inflows of the gold bullion ETF. So even though we've seen this strong gold performance, which generally is driven by investment demand, we haven't seen gold bullion ETFs increase. And so for a while, we were scratching our heads and trying to really pinpoint why is this and what is supporting gold prices and driving gold prices. And other centers of demand typically provide support to the gold price, in our view, more than representing the main drivers. But what we saw last year was very strong net buying by the central banks globally. And now we attribute some of that recent strength in the gold price, especially late last year and into the early 23, to that record level of buying by the central banks. Last year, central banks purchased over 1,000 tons of gold, which goes back, they hadn't bought that much since like 1957. So it is material, and it looks like the strength has continued to 2023. And we think, central banks could be emerging as a more important driver of gold prices.
And up until more recently, they really haven't been, or I guess in recent years, you have different factors. I guess you have central bank buying, you have investment purposes, industry, jewelry. But really, you're saying that it's been primarily investment-oriented buyers in gold. That's been the driver. That's kind of fallen off, and now central banks are at least taking up that position.
Yeah, they're picking up at least some of that slack, right? And if you look at gold's performance and the fact that we did have a banking crisis that extended to Europe, Credit Suisse was involved in that episode, and yet gold was unable to break through that all-time high. And so while we sit here as we speak at that 1960 level, which is a pretty healthy level for gold, and obviously, like I said, 20% moves since last year's lows, we were unable to cross those highs. Honestly, I was expecting, when the situation was developing here with the regional banks, I thought, okay, this is it. Gold is going to cross that all-time high, and it didn't. And it isn't surprising given that we didn't see demand. We saw some inflows as that was developing into the ETF, but not nearly in full force. But to answer your questions regarding how long have central banks been doing, they've actually been net purchases of gold for the past 13 years. So this is a new gold. Central banks buying gold isn't a new thing. The strength, the volumes of last year were record levels, but they consistently have been buying for the past 13 years. The reasons that they put behind those purchases for diversification, as protection against inflation, market volatility, market uncertainty, the same reasons, we think investors should have in their portfolios.
What do you really think is a driver? I mean, it really kind of took off at the end of 22. Do you think it's the Russian-Ukraine war? De-dollarization been a big theme, I guess, in the markets. And I don't know, how much do you weigh on any one of those factors?
Yeah, no, it's honestly when the war broke out, when Russia invaded Ukraine last year, soon after that, obviously, we saw what happened to their foreign reserves. A lot of them they couldn't access, they were frozen. And Russia was, to a certain extent, prepared. They had about 20% of their reserves in gold. And at the time when we saw that situation develop, very early last year, we said, oh, other central banks must be paying attention. We did expect central bank buying to pick up as a result, as you point out, of the Russia experience. We didn't probably anticipate that it would to the extent that it did, but we certainly think that the Russia experience did inform the central banks. In a way, the analogy I like to make is almost, I think the Russia invasion of Ukraine was a wake-up call to central banks, almost in the same way that I would expect the last black swan event, the recent banking crisis here in the U.S., would act as a wake-up call for broader investors to think about gold and the benefits of gold and why it should be in your portfolio.
Yeah. And I suspect, and maybe it's all related, but I suspect part of that reason that stemmed from the Russian-Ukraine war being, I don't know, central banks perhaps just woke up and said, "Oh my God, what can happen?" And in terms of we can get locked out of certain markets, and so we really need to have kind of more independence from the U.S. dollar.
Correct, and it is a lot of the emerging economies that are trying to beef up their gold reserves. I'll give you an example, obviously a relevant one. China's reserves, I think maybe they're getting closer to 3% of their reserves being held in gold. So even though they They're consistently buying. They've been buying in large amounts recently. The exposure compared to the developed economy, U.S., France, Germany, 60+% of their reserves are in gold. When you compare that to an economy like China's, it's still a very low percentage of their reserves. So there's quite a bit of room there as well.
Yeah, so that was going to be my next question. Like, what is the potential scale then of continued buying and additional upward price pressure in gold markets?
Yeah, I mean, and those purchases are gold price sensitive. Obviously, as the gold price increases, it becomes more expensive to make those purchases. That can dampen demand a little bit. But China in particular and other central banks have sort of, it is pretty clear that they're committed to diversifying their reserves away from the U.S. dollar. So when you look at the numbers that I was throwing around before, I use China because it's obviously the large economy that still only holds, say, 3%. I don't know. I haven't done the math, but to go to even just 10 or 15, or let's call it the 20% that Russia held, there's a lot of gold to be bought still. And that's obviously very bullish for gold demand, not just from China's central bank, but from other central banks around the world.
I wanted to give you a little hard time on gold prices. Every time I think about gold sometimes, and I get this investment story, sometimes it's tough to hold, or at least I guess over the last decade, perhaps it was kind of tough to hold and see it as a hedge. But I was surprised, I don't know why I hadn't looked at it before, but positively surprised to see that gold is actually over the long term trended up, even though since like 2011 to now, I guess it had really just fallen and it hadn't done too much. But it's actually I mean, if you were a long-term buyer, you're doing okay, it seems.
Yeah, and that's we actually include a chart on 20-year performance of gold in our deck, because what we find, especially when we are talking about banking crisis, we're talking high inflation. Those are the things that are very clear to investors. You hold gold because it has proven that it performs well in inflationary environments. You hold gold because it has proven, including this recent events, that it performs well during times of crisis, of uncertainty. And so those roles, I think, are well understood. But then investors get this idea, they're like, you just have them for those situations. We view gold as something that should be a core component and enjoy a permanent allocation in any investor's portfolio. And so the slide that surprises a lot of investors is that gold performance over the past 20 plus years, where we show gold, I think, average cumulative average return, annually versus stocks and I think treasuries. And we show that outperformance over the past 20 plus years, which goes to show, yes, you use it for all those other benefits we talked about, but it actually doesn't do too bad either over the long term. So I think it is important to remember that when you are considering gold, like we would recommend as a core component of the portfolio.
Have you gotten questions from clients about gold's performance in more recent drawdowns? Like, for instance, gold sold off at stocks in 22, and then also at the beginning of this year. And some might say, well, is it the hedge that it's supposed to be?
Yeah, no, I think at times, no doubt, gold and gold stocks sell off with everything during very, very high. What tends to happen is it's a brief period where, the baby and the water and everything is being thrown out. I mess up a lot of the idioms, so forgive me. My husband makes fun of me all the time, but English is my second language, so I get a break. Generally, that, then when gold picks up, that happened during the financial crisis in 2008. Yeah, gold and gold stocks, everything sold off, but then gold took off well before anything else recovered. And what we've seen in this past, gold has attempted to get through sort of those highs 3 times, right? Gold responds. Gold responded to the pandemic. It did trade up, then kind of learned to live with the pandemic, and it did sell off. Then same thing. A war breaks out, gold takes off, trending to all-time highs. And then the world learns to live with that pandemic and everything sort of settles out. And again this year, banking crisis, this is happening. Gold takes off close to the high, not quite through. And then everybody's like, no, we're good. Stock market's so strong. Economy's not slowing down that much. Complacency sets in, and then gold sells off again. But it does respond. The role of gold, to me, I make this analogy, and maybe it's simplistic, but I think it's useful, especially if you're trying to understand roles gold in anybody's retail and institution. Is, you own gold as your portfolio's insurance, and I equate it to like health insurance. You don't know when you're going to get sick. You don't wait until you're going to get sick or starting to feel symptoms to buy health insurance. You just have it all the time because, at some point, you're probably going to fall sick and you need it. It's the same thing with gold, I think, in a portfolio. It's your insurance against many things and against many bad things. The key to remember is how little correlation there is between gold and other asset classes. Very low correlation with everything. And what that means is that it does have great diversification benefits. So that's the role of gold in a portfolio. It has been shown to enhance risk-adjusted returns. So that's Rolls Gold. Rolls Gold protects against inflation, protects against uncertainty. And I think historically, it has demonstrated, even recently, that it does serve that role. Right now, simply sentiment is, not gold positive. Inflation starting to come down. Well, obviously, we're talking today, and the Fed is about to go make a decision here at 2:30 p.m. on whether it pauses, hikes, or jumps. That all affects gold sentiment. And right now, there don't seem to be that sentiment, isn't positive for gold right now. But with that said, we are holding at a pretty healthy 1960. I think the average for the year is 1930, which bodes very well for gold, but special for the gold equities.
And in terms of, and looking outside perhaps the fickleness of investors, what are the top cases, if you will, for continued gold strength? And you alluded to, you expect central banks to continue buying. Are there other major factors kind of top of your head that would support the gold?
Yeah, I think it's important to address the U.S. dollar because that has been the biggest headwind for gold. It's the strength of the U.S. dollar. Coming into this year, we saw a little bit of weakness, which supported gold, but, it's picked up a little bit since. And so what is the outlook for I always tell investors, if you want to try to figure out what's going to happen with gold, which is pretty hard to do, look at what your outlook is for the U.S. dollar because they do have a pretty strong negative correlation. Now, with the Fed looking closer and closer to a pause here in their hiking program, which is a very aggressive hiking program, that should be dollar negative, which should support gold. In addition, we think the economy is, likely going to head into a recession or at least slow down considerably, if not, not only here in the U.S., but also globally. And that it's gold positive. Also, I just think even though the Fed is pausing, the rates are still high, pretty high. And until they start cutting and those rates start to come down, this world will have to deal with these high rates. And we've already seen several examples of the problems that high rates bring about. And there could be more stress. Commercial real estate is obviously very topical right now and what's happening there because of the higher rate environment. But other sectors are also exposed to these higher rates. And that could bring additional pressures to the economy, to the financial system. So we think there is a lot of risk, not to mention geopolitical risk, the fact that we still have a war, tensions, China, U.S., there's a lot there that we think provides support to the gold price, as well as central bank demand and continued strength from jewelry purchases and others centers of demand. The China recovery could be a bullish story for gold. China is the largest consumer of gold. And if things start to improve there, that should also benefit gold demand. But overall, just what appears to me as still quite a bit of risk volatility in the global economy and financial system should continue to support gold at these levels.
Yeah, and I suppose if you're an investor, you can go back to what we started talking about, this divergence between gold holdings of ETFs or basically of investors versus gold price, and all those other factors holding up the gold price and even supporting it. Maybe that's a positive for investors, that there hasn't been a lot of investment demand, at least for the last few months, and now perhaps is a decent time to close that gap.
Absolutely. Yeah, that's that's been our headline for a while. It's okay, COMEX positioning, bullion ETF, those are not near the levels they were last time gold that was at these levels. What happens when that investment demand comes back? Is the Fed pause, whenever that happens, going to unlock that demand? If it does, the all-time high for us seems very well within reach.
Now, so you'd mentioned buying the miners, or you'd mentioned talking about miners or investing in the miners, I should say. Your strategy is relatively flexible, if I'm not mistaken. You can go bullion or miners, but tend to have a bias towards the miners. I wonder if you can tell me about what's been going on with them over the last decade or so, and perhaps what the outlook for miners are today.
Yeah, absolutely. And so for our active gold strategies, we tend to be, for most historically, fully invested in gold equities. We're a gold equity fund. We can own up to 25% of the fund in bullion, but more broadly, we're usually fully invested in gold equities. At present, 1-2% cash. The rest is all in gold equities because we're so constructive in the gold price. And just to make sure this is clear, what investors need to remember as they're considering gold versus gold miners allocation is, one, that they're very, very strongly correlated. And then two, that the miners have very strong leverage to the gold price. And so that's the two concepts that you need to keep in the back of your mind when you're considering allocation to gold versus gold miners. With respect to the miners, and we are, like I said, a gold mining fund, so this is what we do. The miners went through a tough patch during the last gold bull market. And what I mean is they gold prices were increasing high, hitting new highs, and the miners were not as disciplined as they should have been. They put on too much debt. They bought too many assets that ended destroying value rather than creating value. They were basically investing and spending money and growing for the sake of growing, not really paying attention to costs because the margins were so healthy. And that eventually caught up with them, and the market really punished the miners even before gold got into a bear market, say from 2011, 2015. The market had already penalized the miners, and that continued throughout the bear market for gold. As gold sort of embarked in what we call the beginning of the bull market in early 2016, end of 15, what we've seen is gold, like you mentioned, hitting new highs, making up a lot of that ground. And unfortunately, the miners have not really been able to keep up with gold. They have been underperforming gold, in part, I think, because of this perception that they might go back to the mistakes of the past. But what we've seen really since for the past, at least I want to say 5, 6, maybe more years, it's a true, genuine transformation of the sector. These companies are generating a lot of cash, not just at 2,000 gold, but at $1,800, at $1,700 gold. Margins are very healthy because all-in sustaining costs, which is our metric for our gauge for costs in the industry, are averaging, let's call it $1,300 per ounce. So you can do the math very quickly. Those are some pretty solid margins. And these companies are generating a lot of cash. What's happening, instead of taking all this cash and going crazy, building projects that don't offer good returns, or buying properties that won't offer good returns, they're giving a lot of that cash back to shareholders in the form of dividends, which is completely new to this industry, offering very healthy, some of the larger companies, 3-4%, and they're buying back stock. And they're also growing their business, not just by growing production, but by focusing on bringing down costs, containing costs so that margins continue to expand as the gold price increases. And they're being very smart about how they invested in growth as far as mergers and acquisitions and building new mines. They're focusing a lot in lower risk projects. So expansion of existing mines, it's pretty easy to see how expanding an existing mine, adding on to it, finding new reserves, it's a lot better of a proposition investment-wise than going to a brand new greenfield project and building a new mine. So they're being very disciplined, very cautious, which we like. That's why despite, gold prices near all-time highs, we haven't necessarily seen an M&A frenzy. And we have seen some recent activity, obviously very relevant. The Newmont. Newmont is the largest gold mining company in the world, has offered to merge with Newcrest, which is the largest Australian gold mining company. So that's a pretty transformational transaction for the sector, the largest ever. So there has been some activity, and we've seen some juniors consolidate and some other assets changing hands. What we've seen, interestingly, is the miners being very smart in how they design the structures. We had one in particular transaction that I thought really illustrated how they are trying to do things right. We had a company, Yamana, what got taken over by Pan American Silver and Agnico Eagle. And Agnico Eagle already owned a portion of one of Yamana's assets, 50%. So he took the remaining of that asset. And instead of just taking up all of Yamana, Pan American Silver took the other assets, which were Latin American assets, which Pan American has exposure and operates in. So it was a very clean, very logical, lots of synergies transaction that shows that miners are trying to do deal structures that are value creating. And so, we talk about a re-rating of the gold equities. We've been talking about it for a while because they are at historically low levels, just to themselves, relative to themselves, very low valuations relative to gold. So those are good reasons to expect the re-rating. But most importantly to me is the fact that the fundamentals back up, they justify that re-rating as well.
You mentioned new projects in some of these mines and mining operators. Are they doing new projects in gold, or are you seeing gold miners diversify into other types of mining or mining for different types of metals?
We are seeing, actually, I just talked about the Newcrest transaction, and what we're seeing there is actually Newmont adding a lot of copper exposure. Newcrest has several assets that have a bigger chunk of their revenues and valuation comes from copper. So I would say there is copper seems to be the main one that the gold miners are going after. There does remain a focus to stay to be a gold play. So as much as these companies might look for copper, they're still mostly gold. Barrick, the second largest gold mining company, recently announced that they're proceeding with a project in Pakistan that is also a copper project, a very large, massive copper project. So they tend to have some silver exposure. The good thing is that they're looking for value, for returns. So they're looking for projects that are attractive. Yes, obviously with a focus on gold, but they will consider other metals to a certain extent, as long as obviously the economics are behind it.
I wonder if you could tell me a little bit about your background. I was surprised to find out that you started in petroleum. I wonder what's that connection? Maybe it's a very easy connection between petroleum and gold, but I just don't know. How did that come about?
It is an easy connection. So let's talk about how I ended up in petroleum. So my educational background, I'm a mechanical engineer by education. I have my bachelor's and my master's degree in mechanical engineering. My master's thesis in mechanical engineering was in predictive technology for, rotating machinery, basically ways to predict and prevent the failure of large rotating machinery. But I'm Venezuelan originally. I was born in Venezuela, educated here in the U.S. I went to Case Western Reserve University and got my degrees there. But then after I graduated, I did go back to Venezuela for a few years. And not surprisingly, I guess, to anyone that knows Venezuela, I ended up working in the oil industry. So I worked for Shell for about 3 years. And so that was my beginnings in the petroleum industry. Interestingly, I did spend a year in an oil rig offshore Maracaibo Lake drilling, which was incredible.
Holy cow! You live on the rig the whole year, or do you go back and forth? Sorry to interrupt.
So the way it works, I was lucky. It was a short boat ride. It depended on where we were drilling. It was a rig that moves around, a barge, and then but it was usually an hour and a half boat ride. And then we would get there. I stayed one time. I stayed 16 days, which was the longest offshore in this platform. But usually it would be 7 days on, 7 days off, because the way back was so short. We could do that, and so we would go there, live in the rig for a week or more if need be. And there was no, I was the Shell representative, if you might. So it was any time of the day or night. I had to be supervising whatever was happening, but we did everything. We drilled deep, we drilled shallow, we did completions, we did horizontal wells, we did fracking when, people weren't even talking about acid washes. We did all, and I was involved in all of it. So obviously from a technical sort of learning how to operate in those environments from a safety perspective, from just the nature of what you're doing, you're putting millions of dollars down a hole, and you got to make sure in equipment and completion that it goes well. It's so as far as the similarities with gold, after I did that, I moved back to the U.S., moved to New York, decided to take a career shift and go into finance. And my way of leveraging my technical expertise was I figure out, I know I can do this. I can go into equity research, utilizing my technical expertise to provide an edge. And that's exactly what I did. I actually did start covering oil and gas briefly. And then an opportunity came up in the gold mining industry. It's extractive industry, same operational sort of challenges, a lot of similarities. And obviously with my engineering background and my operational background, it was very easy to translate that experience, which has been, we talk about our experience here in our investment team. As far as the technical capabilities, and we have geological expertise, we have engineering expertise, and that is incredibly helpful when you're talking about covering a sector like the gold mining sector. So that experience, I remember thinking, oh my God, I just spent all this work, all this. I remember I had hair like this long, and after the second day in the rig, I came back my second shift, and I cut it up to here, and all the guys were like, "What did you do?" But it was that kind of environment. I was thinking, I did all that a year without, a lot of sacrifice for what? Now I'm like in finance. But honestly, that experience has been invaluable throughout my entire career.
Yeah. I can imagine there were a lot of women on the oil rig, but I don't know. Were there? Were you?
At times, Ed, I was the only one. Most of the time, I was the only woman out of 80 when we were completing a well or doing something that required a lot of service companies. Sometimes that headcount got to 100, and I was literally the only woman. Sometimes another geologist from Shell or somebody from the service companies would pop in, and maybe there were two of us, but it was quite incredible to be such a minority, and it was something that I was used to, obviously, coming from studying mechanical engineering. It was 10 out of 100 at best or less back when I was going to school. And so, yeah, I guess you could say I'm used to working in male-dominated environments.
As we start to wrap up, one of the ways I like to close the podcast is to ask my guests, what's one long-term trend you see playing out over the next year or several years? And it can be about what we just talked about, or it can be about something totally different, something top of mind. I'll let you choose.
Yeah, I think I would like to highlight what I think it's been a good trend, and one that I hope and I expect to continue. And it is the number of women in the boards of mining companies. What we've seen recently, I tell everybody, I get really excited whenever I get, there's been a director change or somebody has been appointed, because what's been happening most of the time when I open those emails to see what the change has been, it's been a woman being appointed. And, we're nowhere close to where I think we should be, but we certainly made a lot of progress. We're seeing a lot of, a lot of boards have 20, 30, 35%, 33% of the women of the board being women. And so that is a trend that is positive and that I hope and expect to continue in the longer term.
All right, trend or fad? This is our speed round. You ready?
I'm ready.
All right, let's see. High yield savings accounts, trend or fad?
High yield savings account. I hadn't thought of that one. Trends? I mean, I don't know. I mean, you got to consider then, are they going to, and by high yield, you mean just because rates are high today?
Yeah.
That's a tricky one, but I'm going to say, a fad, just because people like to invest their money in things that can grow more aggressively than just a savings account.
Electric vehicles, trend or fad?
Oh, that's a trend. That goes without saying. We had people travel to China recently, one of our investment team members, and it's clear that that is a trend.
Fed rate hikes, trend or fad?
That's becoming a fad. I think they're coming close to the end. So I'm going to call that a fad for my own sake.
Yeah. And then this one's interesting. I just read about, you may not have heard of this, but men wearing ladies' watches.
Trend. I haven't seen it, but I can see that as a trend. You know why? Because I think anybody wear whatever they want to wear. It's a trend,
There you go.
We can, wear dresses, wear pants, you do what you do you.
I like that. And then this one's, well, I'm not gonna qualify it. I'm just gonna say it. Artificial intelligence, trend or fad?
That's a trend. It's hard to debate that. I mean, maybe the excitement and the mania and the fury and the sort of overstepping and going too quick might be a fad. Like, you got to put the brakes on some of these things, but there is no doubt that the advancements, the potential, what that unlocks, use, in a smart way, it's got to be a trend.
Ima, this was awesome. Thank you very much for your time and the conversation.
Thank you so much for having me.
And if you want to learn more about Ima and her strategies and read commentaries from her, visit vaneck.com. And with that, I'll thank you for listening to another Trends with Benefits.